Our members, many of them think we're going to have a recession in the fourth quarter, a majority, and yet we're more fully invested than we've ever been in 15 years. Cash typically is at 12%. It's now down to 10. And the biggest shocker is private equity, which our members have specialty because they're entrepreneurs, hit 31%. That was 10% 15 years ago. It's been the greatest transformation of high net worth portfolios. And all of our members obviously are quite successful and have portfolios in the many tens of millions and hundreds of millions, but expressing it through private equity is just an extraordinary change that we've never seen before.
Before we get into the private equity and some of the asset classes you like at the moment, I just wanted to circle back to that inventory number because it does represent the risk that ultimately a lot of the business activity that has driven this GDP number is already activity that's taken place. That's money that's now been spent, and those products and those goods are sitting in warehouses at the moment waiting to be sold, potentially at a discount if they can't shift them. So what do you think that means in terms of borrowing growth from the future?
So, inventory has been like the canary in the coal mine. Right after the pandemic, you had something called the bullwhip effect, where inventory pantries were dry. And now they're starting to stock it up. It's like waves sloshing back and forth. It's one of the reasons the situation is so unclear, because inventories are distorting what most people do. All I know is that our members want to go back to basics. They want to invest in businesses. One of the indications is our members are almost 80% invested between private equity, public equity, and real estate. That's about as bullish on the long term as you can get. And still, they say they expect a recession and are keeping 10% in cash. One other indication is that hedge funds, historically around 7%, have fallen over the decade to 2%. It's an extraordinary visceration of an industry that had so much potential a generation ago.
Michael, if you look at some of the signals, though, you can see why a lot of investors are so confused. I mean, the case for a mild recession or even skirting one, you see a lot of people pointing to the labour market in particular, the strength that we've seen there. That is the one catalyst many are looking at. But then if you just peel away a layer, you can see that there are layoffs coming very thick and fast from corporates. I mean, even yesterday, it was Dow, it was IBM, SAP, and of course Hasbro. So what do we make of some of the language that we're getting from corporates versus what the data is showing us from a lagging indicator?
It's also, a real mixture. At first, it was just the high-tech stocks, high-tech companies that were laying off. And as you now say, it's spreading. But in the smaller businesses that have high growth, I think one of the reasons the recession is less likely, but not off the table, is the economy is so strong, even though the growth rate is slowing. And what people do in this kind of environment is they say, I have to prepare for a rainy day. Let me make sure I have significant cash and liquidity. But there's still amazing opportunities with this level of employment, even in almost every sector. It's just quite extraordinary what our members are seeing. And part of our process is to weed out the imbalance. There's so much noise between the politics of the situation and the global problems. Of course, Ukraine is a deep concern. We're hoping that that gets resolved in the near future. But it's really a back to basics. Don't get worried about recession or no recession. Invest in businesses that are going to be durable no matter what.